This is Aaron Smith with the University of Tennessee Extension on March 10th, 2021. Today, this video will end up discussing the 2021 cotton price outlook. So we look at what's been happening. There's been a lot of movement, what we've seen in price, but I always like to try to break kind of a market analysis down to kind of the three different categories. You can break these up multiple ways, but this is kind of how I'm going to kind of step through it in this presentation. First, we're going to look at kind of what's been going on in futures and options markets. Then we'll do a quick US and global supply and demand estimates, what we've seen in some of those cases in terms of what's really moving supply and demand numbers one way or the other. And then we'll close up with kind of local farm data that can be incorporated into a marketing strategy, marketing plan, and how it will affect profitability and price. So I recently came across this quote from John Robinson from Texas A&M. He's the cotton economist out there. And I think it really puts an interesting point on how we should approach our marketing season. So, you know, I'm cautiously optimistic where prices are headed for the upcoming year. Obviously, we've seen some increases in prices since August of last year. We'll talk a little bit about that. But we do always want to be cognizant about protecting against the downside or taking some of the risk off the table. So the quote that he ended up having was, "Doing nothing all season is a strategy. It avoids upfront option premiums and possible futures margin calls. But the cost of this strategy is bearing the risk of lower prices all season long. In that sense, doing nothing is the ultimate form of speculation." So, you know, as we step through this presentation, hopefully it'll kind of assist people in hopefully making some decisions to take some of that risk off the table. Yes, it does come at a cost and it does potentially forego some upside, but it does end up limiting that downside risk, because we have seen a tremendous amount of volatility and price movements over the last couple of months, and we don't expect that to stop as we move into the planting season and into the summer. So when we look at kind of where prices have been recently, this is the nearby cotton futures, and it also tracks the net managed money positions. And I'm not going to get too much into the managed money positions, but again, right now they're long, and you can see that they're not at all-time highs, but they're on the high side of things. And typically what we end up seeing is as money comes into the futures markets, obviously as some of these institutional investors are buying, we see a rise in price. Now, one thing that is kind of a side result of this is that we do see some volatility as we end up seeing prices get to a plateau and potentially start to end up declining. So we're planning on seeing that. The question is, are we at the point where we will see some of these long positions covered, or whether we'll end up seeing continual purchases from speculators in the market? So if managed money wants to add to its long position, then prices are going to go up. If it decides to exit them, then they're going to go down. And again, it's going to end up influencing that volatility potentially as we end up moving forward. When we look at kind of the December cotton futures, you know, this is one where we can really want to take a look and see where we are relative to where we've been and where we might potentially be going, because this will provide price direction for producers in terms of what current price offerings are, so that you can potentially use some marketing strategies to take some of that price risk off the table. And then also understand, you know, kind of what we've ended up seeing and how you can maybe use a little bit more complicated strategies to maybe take some of the downside risk off, but leave some upside potential to participate in continued market rallies. So when we look at kind of tying the futures market to kind of more of the supply and demand, or market your average price that USDA does put out there, I always like to kind of look at you know, 4 different things when I'm looking at futures price. You want to look at the average. So this is the top line here, is the average of the December futures contract from January 1 to the expiration of the contract for each one of these years. Then we have the minimum, that's the lowest price that the December contract traded at over that same time period, the max, and then what the range is. And the range gives us an indication of the swings from high to low throughout the course of the January 1 to the middle of December marketing year period. So that's on the future side. Then we kind of relate it back to the USDA farm level price estimate for the marketing year. That's important for multiple things. When we look at program selection, for example, for ARC versus PLC, that does factor into the decision-making process. But it also gives us a way that we can kind of compare, okay, what's going on a national basis in terms of farm level price versus what's going on in the futures market, because those two obviously have some disconnects. So we want to always be looking at both of those different prices. And this is currently all the way up to 2021. And so obviously we only have, just over 2 months worth of data in there. So we would expect particularly this range of 12.3 cents to potentially expand out to where it was. When we look at 2010 to 2020, the average price range has been right around that 27 cents from min to max. But you can see there were periods, particularly when we go back to 2010 to 2011, where we had some massive price swings during the January to December, mid-December period. So again, you do have to make adjustments. And then we also want to obviously look at what our local markets are doing as well in terms of adjusting for basis. So we look at kind of futures and options market. We've seen a lot of volatility. We had that big rally nearby futures from a low of 48.35 on April 1st, 2020 to a high of 95.60 on February 25th, 2021. So that's a 47.25 cent move as we look at 2020 to where we are in 2021. So a substantial increase. That's made our price offerings much higher. When we look at December, we peaked back on February 25th at 89.28, but we've retreated back down to that 80 to 84 cent level. We'll have to see. A lot of it will depend on that short-term money movements as to whether we can make another real serious run at that 90 cent level for the harvest contract. Options right now are expensive. Near the money options are 5 to 9 cent premium cost, which does reflect the volatility. There are some positives potentially. Cotton on call positions does provide some bullish optimism that could end up, precipitate maintaining nearby prices, at current levels and maybe pushing them higher as we move into May and July. Managed money positions, I mentioned over 65,000 contracts long. We'll have to see how that, if they exit those positions or if they continue to build positions. That's really going to dictate where those short-term prices go. The one thing that I'm reasonably certain about is that we will continue to end up seeing some volatility and unpredictability in cotton futures markets right now. Now I want to switch over to kind of the supply and demand side of the equation. So kind of more of the fundamental analysis of what's going on with cotton markets, both in the US and globally. So I've kind of broke this down into factors affecting supply, factors affecting demand, and kind of what's positive for prices and what's negative or uncertain for prices. So when we look at positive for prices, we have seen global cotton stocks drop year over year. Anytime you reduce the amount of residual left over after a marketing year, is typically going to be positive for prices. US, what we've seen is some really big in-season adjustments out of the USDA numbers, more so than what we've seen in past years. Where if you think back to June of 2020, the USDA was estimating the 2021 US stocks at 8 million bales. Right now it's estimated at 4.2 million bales, and I suspect that will probably shrink a little bit more as we get closer to finalizing those estimates due to the strong export sales that we've continued to maintain. In terms of supply, one thing that is been a great or pleasant surprise for producers, we do have some very strong prices across row crop commodities. So in terms of bidding for acres is the term that a lot of people will end up using. This high prices does make many crops competitive for acreage, and it'll make it a much more of kind of a regional look at what potentially will be planted. If we look at down in South America, there are some drought concerns, or down in the Southern Plains, there is some drought concerns. When you go into Texas, Oklahoma, that's really going to end up dictating what we're going to end up seeing in terms of abandonment, which is so important to what happens to our domestic production. We're looking down in Brazil. There are concerns for Brazil planting and production. Obviously, it's been well documented that the soybean harvest has been delayed due to late planting. Well, if they're going to plant cotton acres behind that soybean harvest, that is potentially going to be something that could end up seeing a reduction in acreage, or maybe some more issues with making sure that crop gets to harvest and has the yield potential that it normally would. There are a limited number of machine picked export competitors, so that does end up boding well in terms of supplying some of the demand in cotton markets. Negative or uncertain, we really don't know what planted acres in 2021 are going to look at. We don't know what's going to be brought on in terms of abandonment rates in Texas and the other southern plains. And then we don't know what the hurricane season is going to end up bringing to us. When we look at prices, when they're bumping up around that 90-cent range, typically you will end up seeing, higher prices attracting additional production, not just from the US, but from other parts of the globe as well. So again, that could have an increase in the supply of cotton across the globe. Another one that really has to be considered is rising input costs. And I'll talk a little bit about this later in terms of fertilizer costs, but across the board, we've seen a rise in input costs for producing row crops. And then we did have a strong spring crop insurance price that will help minimize the risk for those that participate in the crop insurance program, which is the vast majority of cotton producers. We look at factors affecting demand. Strong export demand from multiple countries. Obviously, China's the big one, and then meeting their commitments under phase one will end up likely involve cotton in a substantial way. So that's a very positive thing for prices. We do have the US dollar index at near 5-year lows. It's come up in recent weeks here, but again, it's still reasonably low relative to where we have been. So that does usually give us a little bit of tailwind in terms of the export market. In terms of demand, obviously COVID-19 uncertainty does continue to linger. We do have price competitiveness issues with fibers, with synthetic fibers. Higher prices can limit demand and result in some substitution. So that is something where we do have to be aware of potential demand erosion if we do see cotton prices. I think anything, definitely north of 90 cents does become somewhat problematic in terms of a substitution effect. China is still, one of the dominant drivers in terms of cotton prices. So, what goes on in China in terms of policy and geopolitics is very, very important. There is still global economic uncertainty, both from, a COVID-19 standpoint, but also from the standpoint of, as we end up getting this economic recovery, what are going to be some of the policies and directions that are taken by governments? And then, bringing it back to the U.S., we don't have a great idea of what U.S. trade policy will be under the new administration. There's plenty of talk about potentially looking at multilateral trade agreements versus bilateral trade agreements, which was more of a priority of the past administration. And you can't really say either is good or bad or advantageous or disadvantageous. It really does matter how those are negotiated and what the details of those agreements are. So we look at kind of some of the numbers when we end up looking at what's been going on globally. This goes from 2006 all the way up to the current marketing year. And as I mentioned, we did end up seeing global consumption exceed production, and so we've seen a shrinking of those ending stocks, and that was obviously positive for prices. The other one too that I think is a real important factor to point out is that these COVID-19 disruptions that push those prices down into the low 50-cent range back in the summer, we really didn't see the long-term demand disruption or drag to be as severe as it was anticipated initially. It's not to say there wasn't a tremendous amount of pain, over the spring and summer and into the fall, but it really didn't end up having that lasting impact that a lot of people were projecting. When we look at cotton exports, it's obviously important to understand who is the US's export competition for cotton markets. And obviously the United States, Brazil, and Australia, those ones are kind of the ones that I think are more closely related just because of the nature of how they produce cotton in terms of their quality and their production methods. So, we continue to see Brazil continue to expand that market share. As I mentioned earlier, we'll have to see what ends up happening for this planting season and their production season to see if they continue to be able to expand that production. When we look a little bit closer in the US here, again, we've seen where we have production estimated at 17.5 million bales. This is right off of the USDA Ag Outlook, and they are expecting cotton stocks to shrink down to 3.8 million bales from the current 4.2 estimate. That could even fall further. So this is for the 21-22 marketing year, so that'd be the 2021 crop. So again, we are seeing some positive news in terms of one, production, two, where that strong demand pull is, and then having that reduced ending stocks relative to increased use is always going to be a positive in terms of moving prices higher. So, it is interesting to see. We don't really have a great handle on what the supply side will be from the US, but it really is demand that makes relevant other factors like production and stock. So, having a really strong demand pull, which, for cotton is mostly going to be through the export market, is so essential to, one, maintaining prices at current levels and potentially expanding them moving forward. So we look at U.S. cotton exports to China. This goes from 2017-18 marketing year to 2021. What we've really seen is a tremendous increase in the amount of purchases from China, when we're up to 3.54 million running bales. And we're, at about week 30, 31 in terms of the marketing year. So again, we've had tremendous increases. Now, you do have to put this in the proper context that we are coming off the trade disruptions with China back in 2018 there. So again, you do have to be cautious with how these numbers are interpreted, but this is very positive in terms of regaining a significant share in China. And I'll point out that we have already seen additional sales for the upcoming marketing year, which indicates that real strong demand pull, which we like to see in terms of projecting higher prices. When we look at cotton imports by country, I guess this is one of the, again, this is global. This isn't specific to the U.S. One thing that's really positive about this is, yes, China is the most important market. It does drive, a lot of what goes on in global cotton trade. But one thing that's really kind of emerged is that we have seen other countries start playing a more significant role on the import side of things. So when you look at for 2021, China was estimated for 25% of cotton imports. So that means there's 75% in other countries. I mentioned crop insurance price. I'm going to transition kind of more on the input side of things here, and then I'll close with kind of my price expectations, not just for cotton, but for other row crops in Tennessee as well. I did mention that our prices are higher. You can look at the projected or the spring crop insurance price for cotton was set at 83 cents compared to last year at 68 cents. That's a substantial difference. It's a completely different risk structure from your crop insurance products if you're purchasing, a similar type product. There was increased volatility, and what that does is it increases the potential or it will increase the cost of your premiums compared to last year if you buy at the same coverage level, right? And so, if you are buying at the same coverage level, obviously your revenue guarantee is going to be higher. Your premiums are going to be more. There might be some sticker shock there for people. So you do want to get with your crop insurance agent if you already haven't, because that closing date is March 15th, just to make sure that you are getting the most out of your crop insurance product as possible. So we look kind of at projected planted acres for 2021. We look at nationally, this is USDA estimate of 12 million acres. They were estimated to be down about 90,000 from the previous year. I think that's probably been bumped up a little bit just with the recent rally. How much we'll have to see. I've seen some that are up over 13 million acres, and obviously that would have repercussions on the supply side if we had a good growing season, but we'll have to wait and see. I do think we'll be a little bit higher than 12. I don't know if we'll get to 13 and a half, but somewhere in between there I think would be reasonable. When we look at Tennessee estimates, about a week ago, back when we were bumping up close to 90 cents, I was more confident about the 325 in terms of 325,000 acres planted. Now that we've seen kind of a bit of a step back, we might be around that 300, but I think 300 to 325,000 acres in Tennessee is reasonable. I mentioned it's incredibly price competitive for acreage right now in terms of soybeans, corn, and cotton, our spring planted crops. All prices are up. Most producers at current price levels are looking at, some profitable opportunities if we get somewhere close to trend line yields. But again, ultimately, what's going to drive planted acreage is going to be how weather proceeds. And, are we going to see big prevented planting numbers? We've seen that in 2019 and 20. Hopefully we don't see that in 2021. We can get, as many acres planted as possible and get a good production year in 2021. When we look at the drought, I mentioned the Southern Plains. When you look at Texas, Oklahoma, and Kansas, you know, there's some issues down there in terms of drought. If West Texas is dry and they can't get that crop planted, and they have harvest disruptions, we'll definitely see prices move higher. So again, monitoring what goes on in Texas is going to be really important to the U.S. Side of the production equation. We look at Tennessee average cotton yield. This goes from 1980 all the way to 2020. 2020, we had an estimated yield of not quite 1,100 pounds. And so what we would anticipate based on the trend line unit is somewhere close to that 1,100 to maybe 1,150 pounds for 2021. Although, you know, again, you do have to put that massive weather caveat on there because you can see tremendous fluctuation based on what weather's doing. In terms of what we've seen over the last, 30 years, on average, what this 15.88 indicates is that's how much cotton lint we've been adding on a per year basis. And so it's best probably not to look at it from a per year standpoint, but a 10 years. So I mean, over 10 years, we've added 150 pounds. One thing that I always encourage people to do is one, kind of benchmark against state averages. So are you improving your yield at the same rate as what our average yield is? Are you falling behind or are you accelerating forward? It's a good way to end up looking at how you're getting or how you're performing relative to peers in Tennessee. I mentioned this earlier, input prices are definitely on the rise. This is just dry fertilizer, but you'll get the same picture if you look at other fertilizers as well. You know, we basically went vertical in these last couple months where we've seen 40% plus increases in the cost of fertilizer, and it's not limited to just that input. So again, when we look at fertilizer prices, crop insurance premiums, fuel, everything has went up. So we're under a completely different cost structure than we were, say, before January 1. If you ended up doing a lot of your input purchases back in the fall of 2020, you are going to have a tremendous advantage in terms of cost structure for this current season. So again, this might be something where people might want to go back and take a look at what their cost of production is, how it's changed, relative to where maybe they were doing some of their planning in November and December, because things have really shifted pretty dramatically in terms of the cost structure that producers are facing. And the reason for this is, I always like to kind of put this up in terms of what are we trying to end up accomplishing here, right? So I took a cost of production of $850 an acre. Every producer is going to have a different cost structure. What you want to do is get to a number that represents how much it costs you to produce that acre of cotton, because what it'll allow you to do is look at what are your likely yield outcomes, what are your current likely price outcomes, and see where you're making money and where you're potentially not making money. And again, that should filter into your decision as to, can I set a price floor? Do I want to forward price some of this production to make sure that I take that risk off the table if there's a profitable level? Obviously, we have uncertainty with yield and we still have uncertainty with prices. And so we do have to be careful with how much we price. We'll talk a little bit about that in a minute. But again, understanding where you are relative to your cost of production, I think is essential in terms of developing a marketing strategy. The other one that I will point out is this does not take cottonseed into effect, so you will want to account for that. That's going to be variable amongst operations, but it's an additional potential source of revenue. When we look at Tennessee cash prices, obviously it's very early in the 2021 production season, so prices are highly uncertain. Big ranges that we end up having. There are some real positives in terms of price direction for our primary row crops. But again, we'll have to see how the current growing season ends up progressing. As planted acreage and estimates start coming out, and as we end up seeing, the planting season progress, that is the potential for the next major market mover. You do have to work a little bit concerned on the cotton side with if harvest futures get over 90 cents. I think that creates an unstable situation on the future side of things. And it also risks demand erosion long term. So again, it's not necessarily a bad thing, but there are potentially some consequences if we do end up seeing, harvest futures up around that level. And there is a chance that we will. There's some very bullish tailwinds across a lot of row crops right now. And if we did get a weather event, we could definitely see over 90-cent cotton, bumping up other commodity prices as well. So, very, very difficult to predict right now based on where we're at. So just to have a few closing comments, it's always important to understand the current market environment and continue to evaluate price projections and yield potential throughout the marketing cycle, and make some decisions to maybe remove some of that risk off the table. The amount that you price at different times of the year is operation specific. Every marketer is gonna have maybe a little bit of a different strategy, but I think given where we've been in terms of the price offerings, I would be very concerned not having anything priced at this point in time. Having something priced prior to planting in the neighborhood of 25% to 50%, I think is a reasonable risk management strategy based on where we've seen prices recently. I do want to caveat that with not overpricing production or what your estimated production is going to be, because there's two different factors that can come into play there. If you start getting, up north of 75% planted before or priced before planting, you do run the risk of exchanging price risk for production risk, meaning if you can't fulfill the delivery requirements based on adverse weather conditions or production difficulties. The other one too that I will always say is you don't want to price your way out of a potential extended rally. We don't know with high degrees of certainty what direction prices are going to go, but there is some reasons for some bullish optimism. If we got a weather event, a substantial weather event, you don't want to necessarily price your way, up to a maximum, not be able to participate in one of those extended rallies. So one of the best pieces of advice right now is to try to protect that downside. You might want to look at, put options as a potential option. They're expensive, but you can look at adding some protection there. You can look at strategies that will allow you to participate in market rallies. So using call options to end up participating in rallies is a reasonable thing to end up looking at. So with that, thank you. My contact information is on the screen. And hopefully you receive something from this video. If you do have any questions, do not hesitate to email me, and I'd be happy to end up answering any questions you may have.